Welcome back, everyone, to Module 03 of our Explainer series. Today, we're stepping right into the shoes of a controller. We're going to walk through exactly how cash leaves the building and, more importantly, the absolute non-negotiable rules you have to follow to keep it safe. If you're a junior accountant or you're just stepping into a finance role, mastering this disbursement cycle is absolutely crucial. It's literally your ultimate shield against fraud and error. So let's dive in.
Here's our roadmap for today. We're covering 1. How we pay, 2. The approval process, 3. The golden rule of dual authorization, 4. How to handle fraud and vendor changes, and 5. Key controls and common mistakes. We're basically mapping the whole payment cycle from start to finish.
All right, let's jump straight into Section 1, how we pay vendors, looking at the mechanisms of disbursement. We'll start with the foundational basics.
So, we essentially have 3 distinct ways to get money out the door: ACH, wires, and checks. First up, ACH. These are your electronic bank-to-bank transfers. We use them for the vast majority of our routine vendor payments, and they're always initiated through a secure portal. Simple, right? Then we have wires. Wires are a whole different beast. They are instant, and here's the kicker: they are completely irrevocable. Once a wire is sent, boom, it's gone. Because of that, they require the absolute highest level of scrutiny. And finally, we have good old-fashioned paper checks. The physical blank check stock must be kept locked up, accessible to only a couple of designated people. And here's a critical rule for checks: once they're completed, they are mailed directly by the finance team. You never, ever hand them back to the accounts payable staff member who prepared them.
Okay, moving on to Section 2, the approval process, or our rules for release. Knowing the mechanisms is great, but we really need to examine the exact, mandatory process a payment goes through before it ever leaves our account. Before a single dime goes out, it has to be authorized. Every single payment is governed by an authorization matrix. Think of this as your ultimate rulebook. It strictly dictates exactly who has the authority to approve a payment, and that's based entirely on its dollar amount and type. So maybe an AP manager can approve up to $10,000, a finance director up to $50,000, and anything above that, well, that requires the CFO. There are absolutely no exceptions to this matrix. In the real world, the daily workflow is a strict 5-step dance. Step 1, AP validates the invoice. Step 2, the department manager approves the actual expense. Step 3, AP prepares the payment batch, whether that's going out via ACH, wire, or check. But here is the catch, and this is Step 4. A completely separate second approver has to review the full batch and actually release it. Only then at Step 5 is the payment sent to the bank. Which brings us perfectly to Section 3, dual authorization. Honestly, this is the golden rule of Treasury management. The rule is incredibly simple. One person creates, a different person approves. That's it. The person who initiates a payment in the system can never, under any circumstances, be the same person who releases it. And yes, that applies across the board, no matter how small the dollar amount might be. I love this analogy. Think of it literally like a safe with 2 locks. Both keys are needed to open it, and each person only holds one key. Why does this matter so much? Well, if one person held both keys to the safe, they could easily create a fake payment to a fraudulent account, release it themselves, and there would be absolutely no one there to catch them. Dual authorization is your safety net. Now, let's look at why we need that safety net so badly in Section 4, fraud and vendor changes. These are the high-stakes scenarios. Let's contrast a normal, everyday payment with a really high-stakes situation. In a normal routine, say you owe a software vendor $3,500. AP enters the ACH, a manager reviews it, it pays on the due date. Completely seamless. But then, imagine you get an email. It looks exactly like it's from a trusted vendor you've worked with for years. And the email says, "Hey, we've changed our bank account. Please update your records and use this new account for all future payments." Listen to me, this is a massive red flag. Often, this is business email compromise, or BEC, where a criminal is actively impersonating your vendor. If you ever receive a change request like that, your response has to follow these non-negotiable rules. Step 1, do not update the instructions based on that email alone. Just don't do it. Step 2, look up the vendor's phone number from your existing internal records. Never, ever use the phone number they provided in the new email. Step 3, call the vendor to confirm they actually sent the request. Step 4, document that call. Write down the date, the time, and who you spoke with. And finally, Step 5, get a supervisor's sign-off before making the change in the system.
Let's wrap things up with Section 5, Controls and Common Mistakes. Basically, how we protect the cash.
Okay, so here are the classic rookie mistakes you absolutely need to avoid. First, accepting payment changes by email only. We just talked about this, but it is the single most common way companies lose money to fraud. One simple phone call prevents it. Second, releasing a payment without a second approver. Remember, no exceptions to the matrix. Third, paying an invoice before its due date. If you pay early, the company loses the use of that cash before it actually needs to. Always pay exactly on the contractual due date. And fourth, returning completed checks back to the AP staff who prepared them. That's a huge segregation of duties violation. Completed checks have to go straight to mailing.
Instead of making those mistakes, lean heavily on your key controls. Rigidly enforce your authorization matrix and your dual authorization. Mandate those strict callback verifications for any instruction changes. And use the tools your bank gives you, things like Positive Pay, where the bank automatically rejects any check you haven't explicitly approved, and ACH filters. And lastly, make sure managers are doing comprehensive batch reviews, not just blindly clicking approve.
I want to leave you with this final, somewhat sobering thought. If a single compromised email can bypass your team's routine, is your company's cash truly secure? By mastering this disbursement cycle, you are literally the shield protecting the company's assets. But here's the thing. Even with tight controls on the cash going out today and the cash coming in from our previous modules, how do we independently verify that our internal accounting books perfectly match what the bank actually processed? Well, that independent check is exactly what we are going to dive into in Module 04, where we cover bank reconciliations. Until then, stay sharp and keep those controls tight.